Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. I've been an inheritance tax specialist for more than 18 years and have helped hundreds of clients avoid millions of pounds of inheritance tax, both in the planning and in the implementation of our advice. So today's video is around a relatively unusual subject, which is how do you use employee benefit trusts within a family investment company? So welcome back, and today's video is around how you utilize employee benefit trusts within a family investment company. So what is an employee benefit trust? So basically it's usually set up a trust that's set up on behalf of the employees of a company for the benefit of those employees by the definition of the name. It's usually done by large companies. So for instance, Tesco's wants to set up a sports ground for its employees. It puts a few £1 million in, buys the land, sets up a sports ground, and the employees can use it. And there are tax advantages for doing it in that manner. But the rules for large companies are the same for small companies. So when you have a rental portfolio that you've put into a family investment company, what you're usually doing is you're swapping the value of the properties for shares in the company. You can do director's loans as well, but let's go with it at the moment. Let's just say you don't need the director's loan. So you've swapped it. The value of the capital gains that's pregnant within the property portfolio is still in the shares. So when you set it up, it's the value of what you bought the properties for, and if you sold the shares the following day, the value is as the properties are now. So the capital gains are still in the shares of the company, right? So what you do is you set up an employee benefit trust once your family investment company is set up, and you can give some or all of the shares into that employee benefit trust. So you're allowed to claim something called holdover relief, which allows you to put shares into that trust without generating the capital gains. So the point is, it defers the capital gains. The capital gains isn't lost. It's still in the value of the shares. The employees are your children and your grandchildren, so they can benefit from the trust and the shares in that trust. But really it's a methodology of getting the shares out of your own name for inheritance tax, because if you retain the shares, they'd be liable for inheritance tax, right? If you gave the shares away to your children, the capital gains tax gets generated. So the employee benefit trust allows you to achieve putting the shares into the trust without the CGT being generated. It's still in the trust. It would have to be utilized over a number of years, but tax deferred is tax saved. The main point is that you're not paying the CGT at the moment. It can be deferred 30 years if need be, right? So that's the point. The main point of the EBT is for rental properties in a family investment company, and it avoids the capital gains tax being generated on disposal of the shares. Also, to be fair, it's outside of the estate immediately. You don't even have to wait the 7 years as you would do within a normal trust or within making normal gifts of those shares. So that's another huge benefit. Okay, so that's employee benefit trusts and family investment companies. Hopefully you found that useful. If you did, please give us a thumbs up and a like. It's appreciated. But thanks for listening, and goodbye for now. Bye.